Assalamualaikum and hi. We are from Group 6 present to you Sime Darby Company. My name is Numisana binti Kamal. Our objective for this assignment are to develop our skill in calculating financial ratio to assess company financial performance. To identify trends, strength, weakness and areas of concern based on the ratio. To develop analytical skill and practical experience in evaluating a company financial health. To compare the company's ratio in industry benchmark and historical performance to provide context for analysis.
So I will tell you a little bit of the company background of Sime Darby Berhad. So Sime Darby Berhad is a renowned Malaysian multinational corporation that was founded in 1910. The company operates in diverse sectors such as motor, industrial equipment, logistics, healthcare, and insurance, where their headquarters was in Kuala Lumpur.
Here is the trend analysis of liquidity ratio. For current ratio, it is a decreasing trend. In year 2021, 1.63, while in year 2022, 1.52, and year 2023, it is 1.48 times. For quick ratio in year 2021, it is 0.71. For year 2022, it is 0.59. And in year 2023, it increased to 0.63 times. The net working capital is 6,089 ringgit in year 2021. It decreased in year 2022 for 5,757 ringgit and increased to 7,030 ringgit in year 2023. The decreasing trend suggests a slight decline in the company's ability to meet short-term liabilities with current assets. However, it remained above 1, indicating reasonable liquidity. The quick ratio is below 1 in all years, indicating potential reliance on inventory for short-term obligation. A slight improvement is noted in 2023 compared to 2022. A dip in 2022 followed by a recovery in 2023 indicates fluctuation in liquidity. The increase in 2023 may reflect improved operational efficiency or asset management.
Next, I will explain to you about efficiency ratio. Efficiency ratio measures how well a company manages its operation, such as collecting payments, managing inventory, or using assets to generate sales. Which is, it provides insight of potential cash flow issue or over-reliance on assets. Next, ITO. ITO is an inventory turnover ratio, where we use to measure the efficiency of the firm use its inventory to generate the sales. And FATO is used to measure the firm efficiency in using plants and machinery to generate and provide a good quality of the product sales, where the more higher ratio of the FATO indicate the firm efficiency in generating sale from the available fixed assets. As we can see, based on the efficiency ratio in the table, we can see the ratio of the ACP, ITO, and FATO for the 3 years latest in the Sime Darby company. For ACP, in 2023, they take 30 days to generate sales, which is its lower collection compared to 2022 and 2021. And in ITO cases, we can see it's decreased from 4.64 times in 2022 to 3.57 times in 2023, where we can assume that decline in inventory turnover, where it's signaling a slower inventory movement. Lastly, in FATO, it's also decreased from 8.12 times in 2022 to 7.58 times in 2023, where its value can indicate less efficiency use of fixed assets, but the ratio is still high compared to 2021, which is 7.15 times.
My name is Mushada Zuzana. So next, I will explain about leverage ratio. Here is the graph illustrating the leverage ratio for Sime Darby Berhad from 2021 until 2023. It includes debt ratio, showing an increasing reliance on liabilities, debt to equity ratio in time, is reflecting higher leverage over the years. And lastly, we have time, interest, and ratio in time, which is highlighting the declining ability to cover interest obligation. So let's take a closer look at Sime Darby Berhad leverage ratio over the 3 years using this graph. Firstly, we have debt ratio, which is in the blue line. The debt ratio, which measures the percentage of total asset financed by liability, show a clear upward trend. In 2021, it was 42.9%. It increased to 45.9% in 2022. By 2023, it rose further to 53.3%. This indicates a growing reliance on debt to finance the company asset, which may increase financial risk if not managed carefully. So next, we move to the second graph, which is debt to equity ratio in green line. The debt to equity ratio also show a consistent increase, which is 0.75 times in 2021, 0.85 times in 2022, and lastly 1.14 times in 2023. This indicates that liabilities are growing faster than equity, suggesting that Sime Darby is leveraging its operation more heavily over time. The last graph is time interest earn ratio. The time interest earn ratio measures the company's ability to cover its interest expense with its earning before interest and tax. In 2021, the ratio was around 70.87 times, reflecting a healthy ability to meet interest obligation. However, it dropped to 12.44 times in 2022 and further to 6.43 times in 2023. This decline signals reduced capacity to cover finance costs, though the ratio is still above the critical level. Overall, Darby has shown an increasing reliance on debt over the 3 years, which may raise concern about financial risk in the long term.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Alia Husna binti Abdul Aziz. I will present about profitability of Sime Darby. Net profit margin dropped from 3.22% in 2021 to 2.59% in 2022, but recovered slightly to 3.02% in 2023. Return on asset followed a similar trend, starting strong at 5% in 2021, dropping to 3.65% in 2022, but improving to 3.94% in 2023. Return on equity was highest at 8.76% in 2021, declined to 6.74% in 2022, and bounced back to 8.44% in 2023. Evaluation of this in 2021, the company had strong profitability with high profit margins thanks to good cost control. However, in 2022, margin dropped due to inflation, rising costs, and competition. By 2023, profit recovered because of better cost control and smart pricing decision. The return of asset also followed a similar pattern. It was strong in 2021, dropped in 2022 due to higher costs, but improved in 2023, showing better asset management. Lastly, shareholder returns, measured by return on equity, were high in 2021. They declined in 2022 but improved in 2023, thanks to the sale of non-core business and a focus on key markets. In conclusion, Darby has shown strong financial performance with steady profit, stable cash flow, and growth in Malaysia and Australasia, supported by strategic expansion into heavy equipment and electric vehicle markets. However, rising debts and declining interest coverage show financial risk, while improving efficiency and reducing costs remain important. To sustain growth, the company must carefully manage its financial risk and adapt to market challenges.